You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYSHEX.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how are you doing?
Excellent. Calling in from sunny California here for the TPM conference.
We're in the same city, but not in the same podcast recording booth. We wanted to make sure we had good audio, so we kept it separated still. We also have Gordon Downes, the CEO of NYSHEX, joining us today. Gordon, how's it going?
It's great. And I'm so happy to be on the pod with you guys. I listen to you every Monday, and it's great to be on the show.
We love the support. Thank you. All right. Well, we've got a lot of topics to talk about. This week is obviously TPM. We'll get into what people should be paying attention to. But the elephant in the room right now is the attacks in Iran. Lars, can you give us a recap of what's happened so far, especially maybe for those that have only seen headlines and haven't dug quite into it yet?
Yeah, let's start with the facts and then what is likely going to happen subsequent. The fact is that we have basically a shooting war in the Middle East, US, Israel on one side, Iran on the other. This has led to, obviously, a major retaliation back from Iran. What's important in this one is they are hitting back at all the neighboring Arab states. We've seen attacks in the Arab Emirates, in Kuwait, in Qatar, in Saudi Arabia, in Bahrain. So basically, the Iranians say they're targeting U.S. installations, but when you're shooting down 500 drones, which is what they have just done in Dubai, these things fall out of the sky and hit all sorts of unintended targets. What this means is that all flights in and out are canceled, and this has major implications on air freight. Now, our show is, of course, not about air freight, it's about sea freight. So the Strait of Hormuz is next. The Iranians very quickly declared the Strait of Hormuz as closed. What does that mean? Well, just like the Houthis are saying the Red Sea is closed, doesn't mean you can't sail through. It means then you risk being shot at. And here over the last less than 24 hours, the Iranians have made good on that promise. So far, there are reports of 3 different vessels or oil tankers have been attacked. One definitely has been hit and was caught and did catch on fire. When I look specifically at container ships, and I updated it just before we went on the podcast here, you have a whole range of container ships that are now trapped within the Persian Gulf, can't get out, and you have a whole bunch of vessels on the outside that can't get in. If I look at the ones, so far I just made a quick count of the container vessels larger than 4,000 TEU. So we got a fleet to the tune of more than 150,000 TEU of container vessels stuck inside the Persian Gulf, unable to get out. This stuck fleet on its own would be the world's 15th largest carrier. That's the magnitude we are talking about. Let me add a few more facts on that. We had MSC come out this morning and say they are now ceasing booking acceptance to any destination in the Middle East. We then have CMA CGM coming out with $3,000 surcharges on cargo to and from both the Persian Gulf and the Red Sea area. We have Hapag-Lloyd come out with similar surcharges. We have Maersk come out and say that services that they had just begun running through the Red Sea will now again go around Africa, and more telling, CMA CGM. Keep in mind, CMA CGM has for more than a year been operating a few of their services between Asia and Europe through the Red Sea. They have now announced they are also going to go around Africa with those ones. So this is not just a matter of Iran, the Persian Gulf, and the Strait of Hormuz. It's also about the Red Sea and the risk the Houthis are going to start shooting again. So that's where we are factually. Where this will lead us is we will see a bunch of ripple effects manifest themselves very, very quickly. You have a lot of vessels en route towards the Persian Gulf to discharge cargo. They can obviously not go in there. We had the same situation a bit over 2 years ago with the Red Sea when ships couldn't go into the Red Sea. So when you cannot go in, discharge your cargo, what do? You discharge the cargo in the nearby transshipment hubs. So this is likely going to lead to a massive amount of cargo now being discharged in key locations in the region like Salalah, Copacan, Sokar, Colombo. And if we think back 2 years ago with the beginning of the Red Sea crisis, this also overwhelmed ports such as Singapore. And with carriers suddenly saying we are not going to accept bookings into the Gulf, you could likely also see them not load that cargo in origin. So this doesn't have to drag on for very many days. Then you get congestion in major ports across Asia. Once you get congestion in major ports around Asia, that soaks up capacity. And if there's anything we have learned the last 6 years, when you soak up capacity, you tighten the market, and suddenly freight rates shoot up rapidly, even in trades that are not directly impacted. So to sum all this up, we have a shooting war. It has de facto for container ships closed the Strait of Hormuz. We are likely going to see rapid spikes in spot rates spread like wildfire on many trades. It is completely unpredictable at this point how long will this last. We might be lucky this is over by tomorrow. We might be unlucky this drags on for months. We have no way of knowing right now.
Okay. So I remember talking about last week, TPM is coming up, and last year we had all this news drop right at TPM. Could have never expected something of this magnitude to happen right before TPM. I'm sure it's shifting some of the conversations that people are going to have starting this week. A lot of volatility in the market, that's for sure.
Yeah, and maybe to add to that, prior to coming to TPM, if it wasn't for the Iranian affair, the cards were actually decked against the carriers because we were heading into a gradual normalization of the Red Sea. We could see that with a couple of the Maersk services that had also switched over, and a normalization of the Red Sea would lead us eventually into overcapacity and a weaker market globally. That equation has changed over the last 48 hours materially. And I would also say any hope of normalization of the Red Sea is postponed at the very optimistic part to somewhere in the second half of 2026. So what looked like a weakening market favoring the shippers now suddenly looks to be exactly the opposite. And here we then have the problem for the shippers. How do you plan for this for the rest of the year? Because no one has the slightest idea how long this conflict will last. So this is going to be a roller coaster ride in terms of rates.
Yeah, agreed. And it might be worth touching on where the current rates are at right now, but we'll spend some time talking a little bit more about some strategies that shippers might want to use going into this new contract season.
Yeah, the rates are still declining slightly. You can say that's the aftermath of Chinese New Year. The real issue is right now, today, there are none of the indices out there that tells us what is actually going on, because none of the indices, of course, capture what happened here Saturday and Sunday. So that's going to unfold in the coming week. And this might also be a good way of then saying, well, how will the different indices tend to respond to this? Because I want to bring up something, let's coin a new term, call it phantom GRIs, or phantom rate increases. We have seen it before, and I think, Caroline, you have prepared a very nice graph that at least we can talk to. And for those of our listeners that are not watching us but are driving cars and hopefully not driving into something, trying to see the screens, let me explain a bit what we're seeing here. There's actually a comparison, and we've touched upon the topic on a few previous occasions in the podcast. It's the SCFI and the NYFI, because on paper, both measure the same thing, one of the spot rates, in this case, say from Asia to US West Coast. But what you also see at times is you have multiple occasions where the SCFI spikes quite a bit higher than what you see on the NYFI. And that's what I would call the phantom GRIs. And basically what happens at those points in time is there is a sentiment in the markets that the market is now going to be extremely strong. So the carriers go out and quote very high spot rates. And the SCFI measures just that, quotes. It's an aspiration. It's a sentiment in the market. What the NYFI measures is it only measures cargo that is physically loaded on board ships, which means first there is a quote, then there is an acceptance of the quote, then the shipper actually delivers the cargo, and then the carrier actually puts the cargo on the ship. And this, of course, is a process that takes a few weeks, but it means the SCFI measures the sentiment right here and now, whereas the NYFI measures what is actually the reality that transpires. Some would say that the NYFI is then lagged by 3 weeks. No, the NYFI just waits until we see the physical reality on the ground when the SCFI measures the sentiment. Both are valuable indications in terms of what happens in the market. But what this means is, as we can see, when there is a very strong sentiment, the SCFI overshoots. When the market goes down, they are much more in sync. So it's a skewed risk profile between the two. And if we are to apply that to the situation right now, we can already see, I was mentioning it already, we have carriers announcing $3,000 surcharges already now coming into the Gulf. Of course, on the basis of the sentiment right now, it might well be that rates are actually going to increase $3,000 if this becomes really a tight market. Or if the situation resolves itself tomorrow, it's going to be a phantom GRI that will not necessarily materialize. So when you look at the indices, and we're going to talk a lot about this also over the coming weeks, we need to separate between what is a sentiment of feeling that we see in the market from quotes versus the reality that's then ultimately going to play out. And we will not know the reality until cargo has actually been put on the ships. But of course, we should expect spikes in the next few days and weeks, and I'm sure the carriers will try to push this for all it's worth in the contract negotiations ongoing right here at TPM at the moment.
And Gordon, I wanted to pass it over to you to hear a little bit more about the NYFI. So are the surcharges included, like war risk surcharge and the ones that the carriers have announced? Would that be accounted for within the NYFI?
Yes. So the answer is all these mandatory surcharges, as it were, get included. So the price that you see is the all-in price. It excludes some of the local charges that are paid by the consignee or the ship, etc. But for the specifics, it's very easy for anyone to see. You just go to the website and you look at the methodology, and it breaks out very clearly what's included and what's excluded. So the price you see is the total price. And I think that's really important, because if you're a shipper and you're trying to budget for your spend, it's important that the index that you see in the market is able to reflect the total spend for that sort of mandatory ocean shipment.
Yeah. And Lars, in previous episodes, you've talked about the NYFI and SCFI are highly correlated at times. We just talked about the phantom GRIs. They generally move together. Maybe this is a question for you, Gordon, too, but why should anyone care which index you're referencing, whether it's SCFI or NYFI? What are the main differences that shippers and NVOs should be aware of?
If I start off and then hand it over to you, Gordon, the main reason why shippers should care is precisely because of these phantom GRIs. Because if you have an index-linked contract and it's linked up against the SCFI, for example, you would end up paying these very high rates that are measured by the SCFI, but are actually not real in the market. Whereas if you link it up to the NYFI, you actually only get what other people are de facto paying for cargo that is loaded on board. As again, I mentioned, the risk profile is skewed because at times the SCFI shoots up a lot higher than the NYFI, but you never see the reverse. The SCFI never goes lower.
That's a great point. And just to build on that, the way I think about it, being a rugby fan, it's like the SCFI perhaps is a little bit more like the halftime score in a big match. At the time the booking is made, what was quoted. But the NYFI is a little bit more like the full-time score. Now, of course, it's great to track the halftime score, but what you really care about is the full-time score. In other words, the price that you pay when you actually have to ship your cargo. And so that's, for me, a really important point about this, shipped rates compared to a quoted or a booked rate. But there are a couple other things that I think are really valuable with NYFI. And one of them is the fact that it's free. Anyone can access it. And not only is it free, but if you go to our website, any shipper, carrier, or NVOCC can get access to a whole bunch of supplemental intelligence. So for instance, you can see lots of historic data, you can see trades, you can see sub-trades. And just recently, we've added in a feature which shows the bands. So in other words, the NYFI, just like the SCFI, shows the average price in the market, which an average shipper, in theory, would pay. But of course, if you're a much bigger than average shipper, you'd pay somewhat less than the NYFI or the SCFI price. And if you're a much smaller shipper, you'd pay somewhat more. So what we've done inside the application is we've made it very clear to everyone, what are those different rate bands? So what are the smaller shippers paying compared to the bigger shippers? And of course, the average NYFI would be representative of what the average shipper is paying. So that's just some examples of these supplemental intelligence. One other thing which I think is valuable about NYFI is the way that we designed it has always been based on the needs of the industry in a very balanced fashion. So we have set up what's called an index governing board. The index governing boards consists of shippers, carriers, and NVOCCs, and all decisions around the index are made by that index governing board. And that ensures that it's equitable, there's balance, it's fairness, and of course, all of those decisions are then published in the form of the methodology. The meetings are overseen by the Federal Maritime Commission under the agreements we have on file. So there's a great deal of scrutiny, transparency, and fairness that's baked into all of the decisions that get made here. And I think that's not only is it good to ensure that the index is factoring in the needs of the market, but it's also good if you're going to trust the index to determine the price that you're going to pay, or if you're a carrier, the price that you're going to receive. It's good to know that everything is completely trustworthy, transparent, and fair.
Definitely. I think another thing worth calling out is that the SCFI is obviously limited to Shanghai exports. NYFI is global with increasing trade lanes every day. So obviously, if you're focused more on other sourcing regions other than Shanghai or China, you might need some more robust information.
As you're correctly putting it, Gordon, the index is what an average shipper would pay for an average shipment. But in order for people to do index-linked contracts where a contract is linked to an index, that doesn't mean that you have to pay exactly what the index says. I mean, I've at times come across shippers say, well, if the index says 1,200, if I have an index-linked contract, that means I have to pay 1,200. That's not really the case. That's between the shipper and the carrier. If they agree that the index is the right benchmark, the shipper and the carrier could agree, yes, you always pay index minus $200, or you always pay index plus 5%, or whatever offset the shipper and the carrier can agree to. The index is just to measure what are then the changes over time, but an index-linked contract doesn't mean you have to pay exactly that number the index says.
The traditional contract setup is based on one contract rate for the whole year. And so if you think of an index-linked contract, essentially aligning the contract price with real-time supply and demand, rather than betting on where it would be, 6, 12 months from now and having to potentially renegotiate with your carrier partners over and over again. It's an easier way to do that.
It then raises another question, because it all goes into why is it that there is a contract, say, for 12 months between a shipper and a carrier? At least in theory, the intention is that there is an agreed price. The shipper agrees to show up with a certain amount of volume. The carrier agrees to have capacity to move that volume. And as I think everybody who's been in this industry more than 5 minutes knows, these contracts tend to go out the window when the spot rate then changes dramatically, either up or down. That happens every single time. The question at times then is, okay, if you do an index-linked contract, what's then the purpose? Why not just go on spot anyhow? And I would tend to look at it differently and say, one of the reasons you have the contract is precisely so there is alignment on volume commitments. And if you then vary with spot rates, there's a much higher likelihood that both parties will actually honor that volume commitment, because neither of them have really any financial motive to renege on the volume part. For a lot of shippers, it's a matter of, can I actually get my cargo moved? For the carriers, can I actually get the slots filled that I'm hoping for? So the volume part then sticks. The problem then becomes, then you don't know necessarily what the rate is, which is true in the index-linked contract. And that's where, at least I'm going to hand it over here to you, Gordon, but from my perspective, that is something that should not be done by the supply chain manager. That should be done by the finance department on either the carriers or the shippers, because that's more a financial transaction to hedge off that risk more than anything else.
Yeah, that's a great point, Lars. I'm glad you brought that up, because as we've talked about many times, we are building the NYFI index in conjunction with the launch of a futures contract that will be settled on the Intercontinental Exchange, or ICE. And why is that so important? It's because it exactly supports what you were just describing. If you're a shipper and you've got a contract where the price fluctuates as the index goes up and down, but your finance department wants more certainty on how much you're going to pay, now it becomes possible for your finance department to use hedging. And there are many different ways of hedging, using derivatives, etc., to be able to mitigate that risk. But effectively, the finance department can take an insurance policy so that if the prices suddenly ramp up, of course, you still pay the price to your carrier as it follows up with the index, but that insurance policy, so to speak, pays out and it offsets whatever that increase is. And of course, that's just one example of the different hedging strategies, but that's just a simple option. Just like an insurance policy with an option, you pay a premium, there's a strike price when it hits, and of course, you get a cash payout if you surpass the strike price, and that can offset your exposure in the market. Just like if you wreck your car in an accident, your insurance policy pays you out and you can afford to cover the cost of that repair or replacement. So there's a lot of tools that are now available in the market with the launch of these futures contracts on the Intercontinental Exchange. And I think you said something very important, Lars, which is this is not in the traditional toolbox of a supply chain manager or a trade manager at a carrier. However, these are very often well-established tools that are being used within a finance department of a big shipper, a big importer, exporter, and a big carrier, including some of these NVOCCs. A lot of these tools are used to manage things like currency risk or interest rate risk or input cost risk and raw materials and so on. So if you're a supply chain manager and you're listening to this and you feel that derivatives are a little bit outside of your wheelhouse, oftentimes if you just go and speak to your CFO or your treasury department, they may be able to help you figure out how best to use these type of tools.
And if I remember correctly, during the peak of COVID, we had a lot of supply chain managers complaining about the CFO is asking me why these rates are so crazy. Well, like involve them again. It's good to get on the same page and keep them aware of what's happening in the market, because we might see some really crazy rates given what's happening right now.
Yeah, fully agreed.
Gordon, could you talk about if you're a shipper, how would you go about getting an index-linked contract? Like, what's the process look like?
Well, I think the first thing is to select an index that you believe accurately reflects what you are going to pay in the market. And again, you've got to look at the various options available. I think there's some big benefits from using NYFI. And one of the big benefits, like I already said, is you can just log in and get access to all the information about it for free. You just sign up with your email address and you can learn a lot about it. But there are other ones out there too. And I suppose you need to look at all of those and figure out the best index for you. The next step is to have a conversation with your carrier partners and decide what type of framework you want to use. Again, Lars just talked about it, but if you're a big shipper, you might want to have an offset against that index because you're bigger than the average shipper, and the larger shippers typically get a discount compared to the index price. Again, if you're a small shipper, you're probably going to pay above the index. So that's a conversation that you need to have with your carrier. Once again, there's some resources on our website to help give you some perspective as to what the small shippers are paying relative to the index, what the large shippers are paying relative to the index. And then as you start to evaluate these different options, whether it's a percentage offset, a dollar offset, a weekly offset, a monthly offset, etc., there's many different options there. One of the big, I would say, tools that you should use is the simulator. So if you, again, go on our website, you can use the simulator, and that allows you to put in all these different inputs and see how that price would change over time using historic data. And of course, you can also put in your historic contract rates just so that you can backtest a little bit and see, had you had an index-linked contract in the prior year, how would that have shaken out for you relative to what your contract rate might have been in the prior year? So all of these tools can then help you to start to form a point of view on what is the right index-linked contract structure for you. And then, of course, as we've just been talking about, I think it's important to involve your CFO. Again, CFOs definitely get concerned when they see prices coming in outside of what was budgeted. This is a great opportunity to bring your CFO sort of into the kitchen, so to speak, and hopefully your CFO can bring some tools by the way of hedging strategies that together can help you build a program that is good for your business.
All right. And then maybe one other question too. So if, say you go about getting an index-linked contract and you want to dip your toes into hedging, what are some suggested first steps aside from looping in your CFO? How do you go about getting that done? How much of the contract needs to be hedged?
A lot of those answers to the questions about how much needs to be hedged will be determined by the CFO based on their sort of risk profile. And again, the CFO will have advice, but there's also practical things you can do. In some cases, if you just want to dip your toe in the water and start off by moving 20% of your overall flow on an index-linked contract and 80% on a fixed rate, that's another way you can manage it. But typically, that's a good conversation to have with your CFO at the start of the process. And then, of course, as you start the hedging process, as NYSHEX, we're partnered with a lot of the leading players in the ecosystem, big banks, big brokers, the biggest exchange in the world. And you can just reach out to us and we'll be very happy to introduce you to the various banks and brokers and exchanges that operate in the space. Now, just a rule of thumb, it's always good to keep in mind that if you're a very large company and you're actively hedging directly on an exchange like ICE today, then it may make sense for you to hedge directly on the exchange. But if you're not currently at the level of sophistication where you can trade directly on an exchange, you don't have those what are called margin accounts already established with the exchange, then it may be a better avenue for you to speak to your bank or to speak to a broker. And once again, depending on what your needs are, we can introduce you to all of these different stakeholders. Lastly, I think it's important to mention that for a lot of us in the shipping industry, these concepts are relatively new and we feel a little bit uncomfortable with them until we've truly understood all the sort of ins and outs and the mechanics of how they work. So one of the things that we've done is we've produced what's called a NYSHEX Academy that anyone can sign up for, and we'll have professionals from the industry actually train you on how you should think about these different hedging tools. What's an option versus a futures versus a swap, etc. And it's quite a fun thing to learn. I think it's always nice in an industry when we have an opportunity to learn new things and then apply those learnings to help our companies be more successful. So the NYSHEX Academy is one of these avenues that we've developed. And we're in the process, now that we're launching these futures contracts, we're in the process of doing roadshows. So in fact, on the Wednesday after TPM, we'll be hosting a workshop here in Long Beach for people who are interested. So you can come along, you can meet some of the banks that we're partnering with. You can meet the key folks from the Intercontinental Exchange. Will be here to share some of their best practices, etc. And we'll be doing that not only here in the US, but we'll be doing that across Europe and across Asia. So I think there's many ways for people to get familiar with this new set of tools. And once again, I think it's really exciting. It's not every day that we get to sort of add new tools to the toolbox, so to speak. And these can be very meaningful tools, especially in light of all these current global affairs that are taking place.
Yeah, if you're interested in attending the workshop on Wednesday here in Long Beach, feel free to reach out to any of us from the NYSHEX team on LinkedIn or stop by our booth if you're at TPM, and we'll get you squared away there. And I agree with you, Gordon. I think, this industry moves pretty slowly, glacial speeds at times. So seeing a new tool and being able to be a part of that and be ahead of the curve is really fun. And it's an interesting switch up in your day to day. Lars, I wanted to pass it back over to you. Is there anything that you want to talk about that we missed? Things that you're looking forward to about TPM? Where's your head at this week?
Well, there's a million different things here at TPM, all about what is going on, but I think a lot of that is overshadowed by a situation unfolding right now. And maybe to loop it back where we began in the conversation, if we think back 6 years, that was when the pandemic first hit and freight rates went to unprecedented highs. And at that point, especially when you talk to shippers, like, oh my God, this is a once in a lifetime event. This was absolutely insane. Rates then started to come down. Shippers then say, that's okay, fine. Finally, things are normalizing. And now we can control the market again. Then the Red Sea happened. And rates again spiked by thousands of dollars, more or less overnight. Then it came under control. I think a lot of people were aiming to come to this TPM on the backdrop of now rates were dropping. It's going to be a normal market, and we're actually heading into overcapacity. And now in the last 48 hours, we have yet another one of these events. I think all actors in this industry have to come to the realization these are not one-off events. These are continuing disruptive events that are born out of an unstable geopolitical situation that has massive impact on the supply chains. And sure, once that might be a fluke, that was the pandemic. Then came the Red Sea as the second one and said, well, we might be unlucky. Now we get the third event within 6 years. These levels of massive fluctuations are not flukes anymore. They are part and parcel of how this industry works, which means it is imperative to start to begin using tools that are designed for handling these fluctuations, because they're not going to go away.
Very good summary. I would agree with you on all of those points. Yep, times are definitely changing. Well, I think that's it for today's episode. Thank you all for listening. If you're at TPM, be sure to stop by the NYSHEX booth. We'll be outside. I'd love to talk to you. Love to meet any fans of the podcast. I've gotten a few messages from you guys on LinkedIn. It's really fun. I hope everyone has an awesome week, and we'll be back next week with a nice recap of TPM. And if any updates come through on the tariff front, we'll definitely talk about that as well. All right, everyone. Have a good one.
Thank you, Caroline. Thank you, Lars.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYSHEX. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.